Monday, December 6, 2021, Monaco 64, home of alternative economics and contrarian views. So it looks like the People's Bank of China, or the Chinese Central Bank, is looking to cut the reserve requirement rate probably within the next week, as Evergrande looks like it's gonna default. It's all but a done deal, it looks like. I think they have a payment due today, offshore coupon payment. And at the same time, in the West, specifically in the UK, the Bank of England is looking to loosen mortgage lending rules, which kind of doesn't make sense, seeing that they want to raise rates because of higher prices or inflation, as some people would call it. It's like doing one thing and then another. It kind of neutralizes everything. So I find it very interesting. So this shows more and more that the talk of policy tightening, not just in China or in the West, is just talk, and that we're going to continue to see more and more loose monetary policy. So before we look into the China story and the Bank of England story, just wanted to say I spoke to my sister about 20 minutes ago. She's in Switzerland. She's just come back from spending a month in Florida with her daughter and her two granddaughters. And she told me about the Swiss referendum. That was last week. I don't think she was back for that, but she told me the turnout was the biggest since the early 70s, when they had a vote on women's voting. And she said she was surprised that the Swiss voted for these restrictions. I think the result was 62% for the passes, the COVID passes. And why was she surprised? Well, because she said a lot of the people she knows where she lives, there's a lot of farmers around. She lives up in the mountains. It's not in the big city. And she said a lot of them refuse to comply to any of these regulations. So she was kind of surprised about the 62% vote. But I told her maybe the fact that this new variant story was released just around the same time, the same weekend that the Swiss were voting, maybe helped the vote go against that, because there was a lot of scaremongering. And I wouldn't put it past the powers that be to have done that, maybe on purpose, during that weekend. And why would Switzerland matter? Well, because it would show how a democratic vote would go. And unfortunately, it hasn't gone the right way. But that's what I wanted to tell you before we look at these stories about the Chinese story. It's on Zero Hedge. I've gone through them. I'm just going to make a summary, really, of what's going on there. I'll put a link to it below in the description. You might want to read it. But it says, China to cut reserve requirement rate within a week as Evergrande braces for imminent default. So they're going through what happened on Friday. There was a meeting between the Chinese Premier Li and the IMF Managing Director, Kristalina Georgieva. And this guy, Premier Li, hinted at reserve requirement ratio cut. Well, that's the ratio of reserves that banks need to keep in deposit. So if you cut the reserve requirement ratio, you release liquidity into the system. And it says here that on this December 15th, there will be 950 billion renminbis of MLF loans that mature. So what is MLF? Well, they're municipal liquidity facility. And a reserve requirement ratio cut would accommodate that the maturity of those loans. So that would help. And the article notes as well, of course, that Evergrande is facing a coupon payment. I think, today. So 6th of December. It says as well, in other news, shares of China's insolvent property giant Evergrande Group tumbled 12% to an 11-year low on Monday. That's today. After the firm said late on Friday what was patently obvious to anyone, that there was no guarantee it would have enough funds to meet debt repayments, prompting Chinese authorities to summon its chairman. The shares fell as a 30-day grace period on a coupon payment of $82.5 million due November 6 comes to an end on Monday. It's strange that it's getting really confusing, because we're hearing from mainstream press like Reuters and Bloomberg that they did make the payment, and now they're saying that the grace period is over. So you kind of wonder, and you have Dr. Metzler in Germany trying to, how can I say, take them to court for non-payment. So maybe he was right all along. What we need to ask ourselves is the following question. Will what happens in China in terms of the property market, which is like 29% of GDP, which is something I wouldn't have known a few months ago, but we have to look at these things. Would it spread into the rest of the world's financial system? I think it could, especially, and we know, of course, that these foreign loans or liabilities that Evergrande has are not that big in the scheme of things, but we don't know how much foreign banks are involved really in the domestic Evergrande market. We know that a lot of foreign banks have gone back into China or have gone into China. Of course, it says here, Evergrande's statement offers its most explicit acknowledgement yet that its $300 billion of overseas and local liabilities have become unsustainable. So $300 billion is quite a bit of money. I know the Fed could probably create that in a day. Yes, I know they don't print money, but they could create 300 billion of reserves that could go into the banking system in one day. But I think things are getting very interesting. We have to see what kind of spillover we get in the West and what happens in China. I can think of HSBC, a too big to fail bank that has a lot of exposure to China. So, yeah, and this is what Zero Hedge notes here. That's why, repeating what it did 2 months ago when the Evergrande turmoil first emerged, China's central bank said in a series of apparently coordinated statements late in the evening that any risk to the broader property sector were contained, which is precisely what Ben Bernanke said about subprime. So there you go. I'll leave it at that. Now we'll look at the Bank of England. If you watched my live stream yesterday, you probably saw that I spoke briefly about one of the Bank of England Monetary Policy Committee members. He's one of the guys who votes every month on monetary policy. He's an outside member. Guess who he works for? Citibank. He's supposed to be a hawk, but now he's saying that with the new variant, they might not have to raise rates in December. And now you have the Bank of England actually looking to loosen mortgage rules, which is really contradictory, I would say, to their broader monetary policy goals, which is to tighten policy because we have rising prices, almost running out of control, I would say. So yeah, that's the article here in the Telegraph. Bank of England poised to loosen mortgage lending rules. Officials are understood to be considering softening affordability checks, but critics warn the move risks creating a housing bubble. And I would argue we might already have a housing bubble, but I think the reason the Bank of England is looking to do this is because they know how important housing values are to the banks. And if we get a slowdown in housing, it could worsen things even more. So let's quickly go through what they really want to do here. So what they're looking to do is loosen the SVR. So it says here, lenders have to check home buyers can afford repayments once any initial interest rate deal ends by testing their ability to pay the reversion rate. While the reversion rate is like a normal mortgage rate going back historically, this is typically their bank's standard variable rate plus 3 percentage points. So it's just like a buffer to make sure that it's like a stress test, so to speak. This is designed to make sure borrowers are not too vulnerable to higher interest rates in future. And it says here, however, interest rates have stayed at rock bottom levels for far longer than officials anticipated when they brought in the rules, while a rise in the base rates to 3% now seems outlandish. And these rules were brought in, it says here, in 2014, I guess a few years after the previous property collapse in 08-09, basically to try to stop that kind of speculation that we had during the real estate bubble that led to a collapse of the whole banking system, right? So now it looks like they're thinking of lowering that rate that they add on when they do the test. So that's what's going on. Some people are arguing, though, that the fact that the stamp duty holiday for buyers of certain homes under a certain amount, it doesn't apply to everyone, that the fact that that holiday is ending could hurt the property market, and that's why they're doing this. But I think this is quite dangerous. They're looking as well to do this, not just the SVR. It says officials are also reviewing the rule which limits lending to buyers borrowing more than 4.5 times their income. So I think it's pretty irresponsible. This is just speculation, but they're supposed to be coming out soon with these new rules. So I think it concludes next week, according to the article. So I will put the link to this story below in the description, even though the Telegraph is a subscription service. Some of you might subscribe to the Telegraph if you're in the UK. So there you go. Let's keep an eye on China, Evergrande. Let's keep an eye on the Bank of England. And with that, let's quickly look at where the markets are this morning. It's almost 8:30 a.m. London time. I noticed Friday that gold and silver actually rallied on the close, which is very unusual. We had non-farm payroll, which is a very weak number. So even the US economy is slowing down, I would say. And surprisingly, gold and silver traded up and finished up on the day. But this morning, of course, the bankers are back back on the paper pedal. So gold is down about $2.50, not much. We're at 1781. Range has been 1791 to 1780, so right near the lows. Spot silver is down 19 cents at 22.35. High's been 22.63, and we are right near the lows. I would say it's probably the Bank of England with their mates at the BIS. Yeah, they work closely together. Anyway, that just gives us more of an opportunity, depending on how the premiums are right now, to keep stacking, to get out of this corrupt, fraudulent financial system. That's my opinion. So the Dow future is up 0.5% or 150 points. The NASDAQ 100 future is up 0.2% or 32 points. The S&P 500 future is up 0.4%. The FTSE is up 0.75% at 71.63. To the currencies, sterling is up 0.1%, 132.49. The euro is down 0.2%, 112.89. The dollar is up 0.25% versus the yen, 113.12. And dollar yuan is unchanged, so 637.26. Aussie dollar up 0.33% at 70.20. The dollar's down 0.2 versus the Canadian dollar, 128.18. And the Kiwi dollar is unchanged, 67.50. Quickly to the commodities, WTI crude is up 1.5%, 67.35. High-grade copper is unchanged, 4.27. Natural gas is down almost 8%, so actually is coming off quite a bit here. It's below 4 now at 378. I noticed though yesterday evening, Javier Blas, who I follow on Twitter, he's the chief energy correspondent at Bloomberg News. This is what he tweeted out: European energy crisis, day ahead electricity prices across large swaths, I think he meant, of Europe have climbed above 250 euros per MWh megawatts, approaching 300 euros in France, Austria and Switzerland for Monday. Amazing also to see Poland at 240 euros. So yes, that natural gas price is going down, but it looks like energy prices in Europe are still highly elevated. So to finish off, look at the 10-year yield. It's up 4 basis points at 1.38%. So if you enjoyed this video, make sure you hit the like button. Please share it far and wide. Think about subscribing to my channel if you haven't yet. And you can also follow me on Rumble, Twitter, Facebook, and all these other platforms below here. I wish you all a great start to the week. Take care. Bye.